Normally what's great about vendor take back mortgage is they don't usually care about you. They usually actually just care about the property and the amount of money you're putting down. So, one thing that I like to do, if a seller immediately is like, hell no, I'm not going to give you a vendor take back mortgage, I'm like, well, what's wrong with the property? Why don't you want to give me a mortgage on it, right? And kind of throw it back into their court. What is up, YouTube? Matt McKeever here, and on today's episode of Deal Destruction, I'm joined by Gleb, and we're going to be talking about a 63-unit apartment building in upper state New York, or I guess maybe it's central New York, in Syracuse, either way. And I'm really excited to dive into this because this is not something exactly inside my wheelhouse, but I am in the process of starting to buy apartment buildings myself. So anyways, I'm really excited to dive into this. Thanks for agreeing to be on Deal Destruction, and how's everything going with you, man?
Excellent. Yeah. Thank you very much for having me on the show.
Awesome. And do you mind just giving a little bit of context right now? So you're looking to invest from afar?
Yes. I'm currently at school. I'm 16 years old.
And, nice, man.
Yeah. So I've been watching your show for like a year, and I'm like, this idea, I've always wanted to start investing in real estate. So I brought you this deal. This isn't going to be my first deal, but I just wanted to know your opinion on it. And because you talk quite a lot about commercial real estate, especially.
Okay, awesome. So I'm just going to pull up the screen share here, but while I'm doing so, do you mind just kind of sharing with the audience what originally caught your attraction about this property, or what got you interested here?
Yes, of course. So I was very interested by the high cap rate offered, and especially the fact that it's multifamily. So therefore, there's ability to, I was thinking there's on the option to increase rents because of the luxury facade of the building.
Gotcha.
That's what I was thinking to do with the property.
And so do you know much about Syracuse?
No, this just came across my eyes because it's upstate New York. It was offered as a high cap rate. I've seen that the cap rates are quite low. So this is marketed as a value add opportunity. So yeah.
Okay, cool. And I don't really know too much about this part of New York either, but I quickly did a couple Google searches just to kind of get my sea legs. And it looks like the population base here is about 150,000, with the metro population area being about 600,000. So overall, just kind of a side note for anyone watching this, that gives me a little bit of confidence. I like really investing in markets where there's a decent sized population base. The way I describe that is I'm looking for usually at least a core city population of 50,000. So this would fit within that. The one thing that I will mention is it looks like clearly this building must have an elevator based upon the height of it. It looks like we're looking at 1, 2, 3, 4, 5, 6, 7 stories here. Originally added April 20th, so it's been on the market for a while. They are offering it at a 8.64 cap rate, and they're saying their pro forma income is $250, and there's 63 units, 30 parking spaces though, which is kind of interesting. Just like a little side note there, I'd expect in like a city this size that you'd really want a parking space per unit. So I don't know if that negatively impacts the tenant profile here, but it might be something to be aware of. And then otherwise, like we're looking at a 46,000 per unit price. That seems very affordable. And I quickly Googled the median rents here. I don't know if you've done any research on what the average rents are in this market.
So the unit is there's a mix of studios, 1 bedrooms and 2 bedrooms, right? So the studios currently go for $630, the 1 bedroom from $715 to $760, and the 2 bedrooms go for $875.
Okay.
Yeah,
that seems very reasonable to me. When I did a quick Google, it seemed like at least the information I was finding was saying that the average rent was in the range of $800 to $1,000 for an apartment. So again, sounds like we're in a decent price point there. And it looks like there's a couple other similar properties we've just got down here that show us, in the 50 to 60,000 unit range. So I guess like obviously this is a bit more of an intellectual exercise for yourself rather than like you're about to pull the trigger today, unless you've really been working hard at those summer jobs. But I think it's awesome that you're starting to really think about, what what is possible, what can I get into, what makes sense from a financial standpoint. So right now at like a $3 million asking price, I know they say like earnest money deposit, so that's usually just going to be okay. That's not going to do anything. That's usually going to be just the initial deposit to tie it up. I would expect that you're likely going to be looking at anywhere from kind of 25 to 40% down on a property like this. If we assume kind of 30%, you're looking at about $1 million down, right? And so that's usually going to be the biggest hurdle for anyone trying to get into a deal like this. I like the fact that it exceeds the 1% rule. So I'm a huge believer in the 1% rule. I know some people like to hate on YouTube about that, but literally we even use that when we're buying our apartment buildings these days. We use that as a quick analysis tool and then determine whether we want to do deeper due diligence on it. One thing that I would just note, circling back to that elevator comment, is really getting an understanding of how up to date and serviced it is, because those can, if it's got a lot of deferred maintenance or it hasn't been kept up, that can become a bit of a money pit. And you could easily be looking at racking up six figures in repairs and maintenance and things of that manner. And then, yeah, like beyond that, it seems interesting to me. I guess the one thing I would recommend to any outside investor looking to break into a new city is you just need to really get dialed into what's going on in that market, right? So if you haven't already done research on things like what the population growth trend is, that's like one of the first things I look at, right? Is the city growing or dying or staying stagnant? And if it's not growing, usually that I'm going to be very cautious wanting to move into that market. Beyond that, looking at things like vacancy rate. So I did a quick Google and it looked like vacancy rate was around 7 or 8% from the information I was able to find for that area. And beyond that, then, finding out what the average rents are, as well as just where the employment picture is. And right now it's a little bit harder to know with COVID-19 because it's not like we're getting up-to-date stats, but certainly something that I think every investor would be well-to-do to keep in mind at all points in time. I guess, yeah, from like a practical standpoint, like this is the sort of building that me and my partners are attracted to. The biggest thing that would scare us away is the elevator and the potential lack of parking, just because my perception is that might negatively impact our tenant profile. Do you have an income statement for this?
Of course, yeah, I do. So they're currently receiving so last year they received $543,000.
Okay.
And that was the income, yeah.
Yeah, that was
And,
the gross rents. And then obviously they had about 300,000 in expenses to get down to that 250 NOI.
Yeah, so they're around 54% expenses.
Okay.
So, yeah, and they're charging 10% for property management.
Okay. Like I like to see that because a lot of people in their pro formas, they're going to skate over expenses like that. So what did they allocate for repairs and maintenance?
Oh, they didn't allocate anything. That's the funny thing.
So they did property management, but they didn't do repairs and maintenance.
Yeah. So in terms of they barely. So in total, so they just allocated 19,000 for expenses.
Okay, gotcha.
Yeah, anything, yeah.
So $19,000 for kind of the repairs and maintenance expenses, but that was it.
Yeah.
And so are they paying the utilities or are the tenants paying the utilities?
They're paying for cable, they're paying for electricity, for gas, for...
Okay. Is this oriented towards students? Like, is this a student rental?
I think it's like 7 minutes away from Syracuse University. And
okay, yeah.
A call from the hospital. So
is your understanding that most of their tenants are students?
No, looking at the statements, the majority of them have a car. So they are renting out the parking space for $90 a space.
Okay.
So yeah.
Interesting. So yeah, I guess circling back to repairs and maintenance, all other things being equal, you know, when I'm just forced to kind of make assumptions, I usually like to do about a 5% of gross rents, repairs and maintenance allowance. So that would put me at about $30,000. So actually, their 19,000 doesn't sound um, terribly off. So that's an okay start there. So it seems like they did a decent job. Property management at 10% sounds quite reasonable to me. And yeah, I guess the one thing that does stand out is the fact that they're kind of paying for all utilities and all cable. Normally, at least in Canada, I would expect either that this is going to be geared towards students or potentially like more retirement, you know, retirees that are empty nesters.
Yeah,
So one little caveat I would put, obviously, student rental properties can be a mixed bag depending upon the management and the type of tenants you're attracting. So if this was a student oriented building, one thing you might just want to really look closely at is the insurance costs and factors like that. Here in Canada, a lot of companies are starting to shy away from student rentals. And so we're starting to see significant increases in the cost of policies when it comes to insuring your student rental. And then the only other factor is if this is a student rental property, or if it was, then just understanding exactly what the local university is doing. Because again, here in Canada, at least, it's very hit or miss, and it's school by school and region by region as far as their policies for like, are they going back in September? Or are they going to wait until January 1st because of COVID-19 and factors like that? But yeah, like this is a interesting property. Definitely, again, if I was breaking into a new market, I would really be looking to get some boots on the ground. So, you know, build out a power team there, get a local realtor, get a local property manager, get an inspector that can kind of walk through the property and really get a feel for it. But everything on the surface actually looks pretty
yeah.
solid. And it sounds like, based upon your initial research, the uh, at least compared to the comparables, if anything, it's below where you'd expect. So,
Yeah.
any idea why the owners decided to sell?
I mean, they're owned by a big company, so I'm assuming they're not like very interested in trying to increase the rents. Like, because we have opposite the street, there's something called Casson Apartments, and it's more of like a luxury. Like, it's the same looking tower, but they're charging 12.50 for a two bed, which is
Oh,
like, oh,
wow.
yeah,
Interesting.
yeah,
So, yeah, I guess one thing that maybe just to be careful of in case, like, make sure that none of this is geared to income housing, or like they haven't signed some sort of contract with the government that forces them to rent below market. Here in Canada, there's certain government programs and subsidies you can apply for as a landlord, and you'll get like a bulk lump sum of money to renovate the property or buy the property, but then you're kind of forced to only rent it out at like 70% or 75% of fair market value. And that's kind of one of the ways we do subsidized housing here, is through some of those grants and forgivable loans. But yeah, I mean, like everything on the surface looks interesting. Um, I'm kind of curious why no one's picked it up if it is below market. So whether that's just COVID-19, again, there's a lot of uncertainties. So we're finding, for myself, in June and July of this year, we were able to really snap up some great deals because everyone else wanted to sit on the sidelines and just kind of see what's going to, you know, is this the end of the world? What's going to happen? All that good stuff. But it really, you know, it's really starting to seem like things are returning to normal, and we're starting to see a lot more liquidity enter back into the market and a lot more money competing for the same real estate assets here in Canada. So I wouldn't be surprised if either New York's experiencing the same thing or will be soon. Um, yeah, I like, actually, compared to most of the deals that come on here, this seems pretty solid overall. Like, obviously, your biggest challenge would be your age and lack of capital. Again, in theory, you could try and put together a joint venture on something like this. You're going to need a serious capital partner. And a couple thoughts on how to structure a deal like that. I guess just for yourself and any of our viewers at home. So this is something that Casey Wong from my channel has kind of, he and I have talked about this at length just to get some perspective. But, you know, when you're structuring your JV, there's more than just the partnership aspect of it. There's also the day-to-day operations. So the operations and management, as well as the acquisition. So, for example, if you were looking to really start getting serious about breaking into this market, one thing you're going to notice is there's significant costs once you start moving into larger multifamily properties in regards to your due diligence process.
Hey YouTube, are you guys looking to buy a rental property? If the answer is yes, then you need to pay close attention to the following information. Nitty Gritty Real Estate is a company that's here to help you buy a rental property in your market in as little as 30 days. Investors typically learn real estate by watching YouTube videos, joining Facebook groups, all kinds of different things, reading books. However, I see tons of people spend a lot of time and money and yet never end up taking action because they still don't know how to actually get started. Does this sound familiar? The best way to learn something is by actually doing it. And so Nitty Gritty's experienced team will actually walk you through the entire process of how to buy a property, rehab it, get it up and operational, and they'll even provide you with contacts if you need to set up the real estate business. So if you need lawyers, accountants, things like that. But go to nittygrittyrealestate.com for additional information, and you can click the link in the video description down below to hop over. But again, they're really just here to help facilitate and get you launched into your real estate investing career, and they'll give you a free consultation with no obligation whatsoever. So again, link to everything that we talked about is in the video description down below. Jump over and talk to Nitty Gritty Real Estate, and why not get started today?
There's significant costs once you start moving into larger multifamily properties in regards to your due diligence process, anywhere from, you know, $20,000 to kind of $40,000 doing our due diligence before we even know if we want to buy the property. And obviously that adds up, especially if you don't buy every property you do due diligence on. And realistically, if you're buying every property you do due diligence on, you're probably not being picky enough, or you're being way too picky, one of the two. And so in that manner, what we do and what a lot of other operators in this space do now is they charge like an acquisition fee, right? And so oftentimes that might be anywhere from 1% to 4% of the purchase price of the property. And this is something that you and your little business that's acquiring the property that then is trying to bring in a JV would charge your JV partners. And this will kind of help for any sort of deals you do where, you know, you do your due diligence and then you can't proceed either because you don't want to or a JV partner doesn't, rather than you just eating those costs. That can be a way to do it, as well as like a loan sourcing or a kind of an admin fee. And oftentimes what people will do again is 1% to 2% of the borrowed amount. And so if you were, say, working on behalf of your JV partners to line up and get all the debt done, right? So say they brought $1 million cash, you guys are going to have to borrow $2 million. It actually can still be quite a process to get access to that money. So you can end up spending a lot of time and energy doing it. And then finally, if you were going to take over the day-to-day operations, some sort of operations charge. So this could be like a property management fee. It could just be a management fee. There's lots of different terminology we could use for it. But again, usually this is going to be anywhere from, if we ignore what the actual property management value is, this is normally going to be anywhere from 1% to 5%. So for example, with my company, we now charge 5% just as an overhead fee, because like I hire like a secretary and front staff and stuff like that. And so these aren't costs that you can necessarily directly tie back and charge to a partnership, but it is a general overhead that you have to kind of carry, or burden you have to pay for as the active partner, the partner that's out there actively finding deals, doing the due diligence, all that stuff. So I guess just some general food for thought here in regards to if and when you start getting a bit more serious about doing the due diligence. But like, yeah, I think you personally found an interesting property that, you know, on the surface, at least, I can't really poke any holes on. The biggest one is just, and I've done this on a previous video, make sure that income statement you really go through and double check and source everything. So like I've had it before where people send me a Excel document, or they give me a print off of a basic net operating income statement, but then it doesn't actually add or sum. So like, you know, a line got deleted and all of a sudden the formulas don't work anymore, or someone overrode the formulas with an input rather than being formula based. So always make sure you just kind of go through, do that basic due diligence on it. Because it can be surprising what you see. But, glad to hear it had a property management fee. Glad to hear you already identified that repairs and maintenance looked a bit low. And at a 54% expense ratio, like that's right where I'd expect it, especially if the property is slightly under rented. Because once we increase the rents, then as a ratio, it's going to drop down a bit for us. Yeah, that's really all I got. So if you got any questions, feel free to hit me with it.
Oh, yeah. So I wanted to know what can be like the game plan later on after we acquired and stabilize the property.
Yeah. So usually when you're buying a property like this, you might finance it with short-term debt, right? Which is usually going to come at a higher cost. So I don't know what borrowing rates are in the US, but here in Canada, you might end up borrowing for a 6-month to a 24-month term to stabilize the property. And during that time, depending upon exactly how you finance it, anywhere from 6 to 6 to 12% would be pretty common. If you're really levering up at like 100% loan to value, then it could even be higher than that. But normally you're going to be looking at like a 65, 75% loan to value, probably be paying anywhere from 6 to 12%. And what you're going to want to do is try and generate, like, at the end of the day, you need to get the rents up, right? So that you can go back, refinance it, maximize your cash flow. So one, you'll have to figure out or get an expert on your team to understand the intricacies of New York tenancy laws, because each region and state is specific. I know New York City itself has some pretty strict tenant laws, but I don't know if that applies to the entire state or whether that's just within the city limits of New York. And then once you understand that, you're going to need to figure out what's the best game plan to generate that tenant turnover. So if you can legitimately just ask people to leave, cool, you could do that and turn over the units, get it fixed up and higher end. Here in Canada, it's going to be rare that we're going to have a jurisdiction that allows you to do that. So often we're going to be implementing cash for keys, and that's where we buy people out of their tenancies, right? So I know my buddy Graham Steffen, he's in California, and California has some of the strictest rules there is when it comes to tenancy laws. And so it's not unusual for them to offer like $30,000 to try and buy a tenant out of their tenancy and have that tenant say no. It blew my mind when Graham told me once he offered a lady $30,000 and she told him to go to hell. Here in Canada, like in my market of London, Ontario, we're normally going to be looking at about $5,000 per unit buyout. So we find usually about 4 to 5 times monthly rent is enough to incentivize a tenant to decide to move on. So for example, knowing nothing else about this market, my guess would be if you're averaging $700 a month in rent, maybe you can do your buyout somewhere in the range of like $3,000, maybe $4,000 to buy out those tenants and turn over the units. For us, we factor in all those costs into our acquisition model. So literally what that looks like is the same way it cost me $5 a square foot to replace flooring. I just factor in $5,000 to buy out a tenancy. So it's just built into my spreadsheet the exact same way any other cost would be. I know a lot of newer investors they kind of get hung up on this, or they've got a limiting belief and they're like, why should I pay this tenant to leave? And I'm like, man, leave the emotions at the door. This is all just a business decision, right? So if the numbers make sense, I'm going to move forward. If it doesn't, then I'm going to renegotiate or find a way to tweak the terms to make it work. One last thought is, and obviously I have no idea about the seller, but oftentimes when we're looking to acquire a property where we know we're going to want to stabilize it or turn it over in a short period of time, one of the first things we're going to do is see if there's the opportunity for a vendor take-back mortgage. And often with my business model, what we'll do is we're actually willing to pay a premium for a property to get a vendor take-back mortgage. So for example, if you were to say like, hey, Matt, I got this lead, how would you approach this deal? First thing I would do is probably hit them with a vendor take-back mortgage. It's been on the market for 144 days, so it's not like people are beating down their door. So assuming that there's no sort of like environmental issues, as in the land's not contaminated or anything crazy like that. First thing I'm going to hit them with, you want 2.9 million? What if I gave you 3 million? And so like literally offer them more than what they want, But what I'm going to need from you is a 85% loan to value first place vendor take back mortgage for 18 months while I stabilize this property. And for the first 6 months, I don't want to make any payments.
Okay.
And so this is something we regularly do, because what that gives you is like this runway, right, to jump into the property, start turning over the units. This property should already be cash flowing just as is. So you're going to be able to like stack up some money as well to help you renovate the properties. If you can get that 6-month runway, we find that to be a very effective cushion when trying to turn over a property like this. As well, one thing I didn't mention about the private financing that you might be looking to get on a property like this for the first stabilization period is often it's going to come with like expensive fees, right? So it's not unusual for us to pay a 1 to a 4% setup fee to the company we're borrowing money from. So if instead I can get the seller to give me a vendor take back mortgage for a short period of time, even if I pay them a good interest rate, it often, once I factor in all the costs, ends up being cheaper. And normally what's great about vendor take back mortgage is they don't usually care about you. They usually actually just care about the property and the amount of money you're putting down. So, one thing that I like to do, if a seller immediately is like, hell no, I'm not going to give you a vendor take back mortgage, I'm like, well, what's wrong with the property? Why don't you want to give me a mortgage on it, right? And kind of throw it back into their court. Obviously, you need to read the room and really understand their personality and stuff. But sometimes that's a way that we can kind of nudge them and either learn a bit more about the property or get them to maybe be more open to considering a vendor take back mortgage. So like that would really be my thoughts on how you go about doing this. Again, if you're going to be doing this remotely, you're going to need a like boots on the ground team, right? One of the big things is just day-to-day management of that as well. So there's no excuse in the internet age. Like they can go FaceTime you right at the end of each working day and literally show you the property, show you what's up in regards to what's going on with it. And if you find you're getting pushback from, say, your property manager or your like construction crew, they're not the right people. So like I see investors get pushed around all the time, especially younger investors, by their property managers or their construction guys. And they're like, you don't understand. This just isn't the way it's done. And it's like, no, you don't understand. This is the way I do business. If you're not willing to do business the way I do business, then we're just not going to do business. Awesome, man. Any other questions?
Yeah, I've got a final one.
Let's do it.
So I've searched up online and they found that the average cap rate for a multifamily is 5%. So if we can like cut down the expenses, right, to like 45%, like including the property management, that would give us like that would give us a purchase price. If we were to set it as a 5% cap rate, we would get like 5,240,000. Is that possible?
That sounds plausible. The one thing I'm going to caution in that regards is just make sure that you're looking very locally, because like everything in real estate, location, location, location. So make sure you're not comparing to like the Bronx, right, for their cap rates when this is in Syracuse. So I would just really make sure that it's local to that city and ideally in the same neighborhood. But yeah, that doesn't seem unreasonable. Here in my market, London, Ontario, if you've got a beautiful turnkey property, yeah, you might be able to sell it for anywhere between 4.5 to kind of 6.5 cap rate. And if it's in like rougher shape, but has potential, you might actually sell it at a lower cap rate. But the reason it's at a lower cap rate is because the owner knows they can quickly turn it over, maximize it, and get it up to an actual higher amount. Yeah, but that pretty much is the game. Like maximize the rents, reduce the expenses, get a better valuation. And then you've got two options, right? You either sell it or you can refinance it, pull out some equity, and then go repeat the process. And these days, that's what I'm doing with my small apartment buildings, right? We're buying between kind of 10 and 40 unit buildings. And we take usually it's about 12 to 24 months for us to turn around a property. Then we refinance it, pull out the new equity, pay off any private debts or JV partners, and then go buy the next one. Just a slightly more complicated game of Monopoly. Awesome, man. Well, really appreciate you coming on the show, and I love the fact that you're starting to think big and think internationally at such a young age. I'm so jealous of like people your age that just have access to the internet and stuff because, I mean, I can only imagine where I'd be. So I just want to keep encouraging you, like keep doing what you're doing, keep learning more, be like, just be a sponge, right? There's so much great information out there. And again, like this property you're looking at seems the dollar amount's big, but it's actually practical. One of the things that scares me about a lot of new investors is they start chasing returns. And so I see this in Canada where they chase returns way up north in the middle of nowhere. And so they're like, dude, it's doing a 10 cap rate. I'm like, yeah, but it's got like a 15% vacancy rate in the city. Like, you know, it's a ghost town and the population's decreasing every year because no one wants to live in the middle of nowhere. So, you know, like this is a real city and a real state with like real employment. So
Exactly. Yeah.
I'm just really glad to see that you're not trying to just chase returns and like you're in the middle of nowhere. So yeah man, keep doing it.
Thank you very much for having me on the show.
All right.